we are going to discuss merchandiser purchases. And while we go through this, I would like you to refer to Exhibit 4.12 on page 174 of your book, Wild 2014. I also want you to refer to Quick Study 4-3. That is the problem I'm going to do for you today to illustrate merchandise purchase transactions. So the first transaction is going to be from November 5th, and I've already put the debits and credits in here. On November 5th, we purchased 600 units of product at a cost of $10 per unit. Terms of the sale are 2/10 and 60, and the invoice is dated November 5th. So we now need to figure out what accounts we have, if it's increasing or decreasing, and how much we're recording. Okay? So our terms are 2/10 and 60. This means that if we pay within 10 days, we get a 2% discount. If not, the full amount is due in 60 days, no discount. Okay? Since we are purchasing merchandise and bringing that into our company, that would increase our merchandising inventory account, which is an asset account. So merchandise inventory would be recorded first. Okay? We didn't pay immediately with cash. We know that because there are credit terms. That means that we owe the supplier in the future. So rather than us recording cash, we will record accounts payable. Okay, so we're increasing accounts payable. We now need to decide for how much. Well, we know that we purchased 600 units at $10 per unit. So we're going to take the 600 units times the $10 per unit, which should get us $6,000. Okay? So we would go ahead and record that in here. So 6,000, 6,000. Okay? The next entry, it says, return 25 defective units from the November 5th purchase and received full credit. So we haven't actually paid for our units yet, but we found some were defective and we went ahead and returned them. They are no longer in our inventory, they're back with the supplier, and we hadn't paid yet. So it would affect our accounts payable and our merchandise inventory account. Accounts payable would decrease for the amount of items returned, and our merchandise inventory would decrease because we no longer have those units. So accounts payable is first, and merchandise inventory is second. And again, we ask how much. Well, we only returned 25 of those units, okay, at $10 cost per unit, which is $250. That is what we would record. Okay, so 250, 250. The last entry is on November 15th. We paid the amount due for the November 5th purchase, less the return on November 7th. So now the total amounts due minus those that we returned. The first thing we ask ourselves is if we made it in the discount period. We did. We paid on the 15th. It was originally, the invoice was from the 5th, so if we paid within 10 days, we got a 2% discount. Okay? So first what I would do before anything is do the math. Okay? So we would do the 600, okay, 6,000, sorry, minus the 250. Okay, so 6,000 minus the 250, all right, which should get us 5750. Okay, it's from the 5750 that we are going to take the discount. Okay, so 5750 multiplied by 2%. Okay, that is going to end up getting us 115. So our discount is 115. From the 570, we're going to subtract the 115 to get us what we actually are paying. Okay, so after we do that math, we're going to end up with 5,635. Okay? These are the numbers that we will be recording in this entry. So now we have to decide where everything goes. Well, we know that accounts payable will be affected. We're going to decrease that for the total amount that was due, that we originally owed. We know that cash will be affected because we're paying with cash. And merchandise inventory, because we got the discount, our inventory is now less valuable. Okay? So we would record accounts payable as decreasing, and accounts payable would be for the original amount that we owed, the $57.50. Okay? Cash would record what we actually paid, okay, which wasn't including the discount, so the $56.35. Okay? And the difference, or the discount, of $115 goes in merchandise inventory, because our merchandise is less valuable.